If you're an active real estate investor and you're looking to do larger deals, you're in the right place. We are going to go and take the conceptual type of stuff that you listen to from other real estate podcasts and bring it down to the tactical, the nitty gritty, the actual actionable types of things that other real estate investors that went big did to grow their own real estate empire. You're listening to the Go Big Live podcast. I'm your host, Matt Drouin. All right, welcome everyone to the Go Big Live Real Estate Podcast. I'm your host, Matt Drouin of Oak Grove Companies. I have an amazing guest on today, Mr. Justin Moy. With over 10 years of experience in the real estate industry as an owner, investor, and syndicator, Jason is a wealth of knowledge when it comes to building generational wealth and passive income through commercial and multifamily properties. He's passionate about bridging the gap between capital and reliable, consistent, and profitable real estate investments, and has helped countless individuals achieve the financial freedom they are striving for. With a passion for educating both aspiring and seasoned investors, this is a rare opportunity to get up close and personal with one of the top investors and educators in the real estate game. Justin, welcome to the show.
Man, what an intro. I got some to live up to here, man. I appreciate it, but I'm excited to be here, excited to give some value, and hopefully everybody listening live and recorded loves the show.
Absolutely. So I love to start the show with, you were born and now you're here. What happened in between?
Yeah, a lot happened in between. So real estate has been my professional journey really since the start. So my first, non-retail job was in a commercial real estate office. I was an intern. I was 17 years old. I think I made like $6, $8 an hour, something like that, whatever it was. And really my job was to just assist the brokers and the office manager in any task. I'd pull comps. I would help with marketing decks and packages. I would go on property tours with some of the brokers. And I just thought that life was so cool. On a very surface level, me being 17, I didn't know anything about the professional world. All I knew was my mother worked in an office and she hated her life. That's just plain and simple. She hated what she did. She hated what she did. She hated going to work. She just recently, actually last month in April, retired. But it was a long journey from when she started to when she retired. And so that life always seemed so drab and so boring to me. Just go in office, do the same thing every day. And these brokers, they seemed like they were doing something different every day. They would spend some time in office. Sometimes they go outside. They say, if I don't feel like going out today, I'll just stay an office day. Or if I don't want to have an office day, I'll go out and do tours, do things like that. And I just thought the freedom of choice was so attractive. And I think that was that initial hook. Another thing that really sealed the deal for me was I found out that you don't actually need a college education to get into real estate. Now, to me, when I was a kid, school really wasn't for me. I wasn't good at it. I hated it. I dreaded going every morning. And, my parents, being that very old school parenting group, said, hey, you got to go to college, got to climb the corporate ladder. That's how you become successful. And so I was desperately looking for ways to avoid that. And so when I was 18, I got my real estate license, started selling real estate in the Bay Area. Absolutely fell in love with it, was really good at it. But eventually I realized I was transactionally rich, but I wasn't building wealth. After one deal closed, that was it. I got paid once. I had to go on to the next one. And so I decided I wanted to be an owner investor. And, a couple of years after that, jumped into the multifamily space. And now I help people invest passively in commercial assets and multifamily assets. And that's what I love doing.
Sweet. No, it's an awesome, high level story. Now, what was like your first big deal, or what was big to you at the time when you first started your sort of multifamily journey?
Yeah. So, the very first deal, of course, was the biggest deal at the time. It was a 40-unit property actually in St. Louis County.
So now, 40 or
40. Yeah. 40.
Wow. Okay.
Yeah. So pretty good size there. And really what it was is I've always had this go big mindset, right? Which is perfect for the show. But when you read different books and you listen to different podcasts, and one of the common things you will always read in every book, no matter what it is, as long as it's in the self-help space, whether it's a sales and marketing book, real estate book, investing book, anything, they're always going to talk about, what you constantly think of as possible and realistic for you, you're almost going to do, right? There's out there somewhere, there's somebody who says, man, if I could just make $100,000 a year, that would change my life. And there's somebody else who's saying, man, I'm going to go make $100,000 a month. And if they both focus on that goal every single day, over time, they both achieve what they set out for. So to me, that was a really great shift for me. And so I just wanted to look at bigger properties. I wanted to scale quicker. When you do the math behind buying up single family homes. The math kind of, in a way, it sucks because for you to get a certain amount for you to really move the needle, you got to do a lot of transactions. Multifamily, you can kind of do that in one snap. So 40 units, and it was in St. Louis County, which I don't live in St. Louis. I didn't at the time. I didn't really know anything about the market, but that was a big journey, and it was only possible through partnerships. That's a huge thing in multifamily space, in the commercial space, partnerships. I don't think there's really anybody who is consistently successful and really, really big in what they do that doesn't have at least some type of partnership, whether it's one person or whether it's an entire company and operating team. So yeah, 40 units was huge there. It was our first step into the commercial space. We did not syndicate it. Thankfully, we joint ventured it. It was our first go around, so we didn't feel comfortable taking, investors' money. And, thank goodness we did, because the deal went left, right, and sideways, and it still went well, but it could have gone much better had we had been around the block a couple of times. And since then, we learned a ton. And since we have started taking syndication money, we've been able to knock it out of the park and avoid a lot of the mistakes we made on that first one.
Oh, absolutely. Well, let's back up a little bit. I'd like to back up a little bit before the opportunity actually came to you. Like, what was that seminal moment? Because that's like really weird. A lot of people think that, for me, my first deal was a 4-family property, and that was huge to me. So like, what was that seminal moment where it was just like that, like, oh, I got to like skip all that, single family or 3-family. So let's just go straight to 40 units. Like, what was that?
Yeah.
Like, where were you inspired to do that? Like, did that happen over, several sort of like, sort of touch points? Kind of give me some flavor on that.
Yeah, so I do have a little bit of an advantage being in the real estate sales game in the past. So I think, maybe if I was a consultant or I was a CPA or something like that, maybe I would have taken a little bit slower of a journey. But I had sold smaller multi-unit properties, 2 to 4 unit properties, and so to me, looking at the bigger numbers and just understanding that business wasn't as big of a hurdle for me. Now, it is significantly different going from single family investing to commercial investing. Lending is different, business plans are different, management different. So there's a big learning curve still. But since I had a good base in at least real estate in general, I think that did make it a little bit easier than like the consultant out there who, wants to now buy 1 or 2 properties and then scale up from there. Another big thing is conferences. So I'm a big believer in formal mentorship. I did pay for a program, and in the program, they always tell you about, hey, the operational differences between smaller units versus bigger units. And there's different scales you achieve when you have bigger units. There's more leverage you have when you have bigger units. Debt is better on bigger units, typically, than smaller units. And so you have a lot more options. And I felt having that formal mentorship, that backing, gave me a leg up to make myself comfortable to make that plunge.
So were you in a program before you bought this 40 unit or what?
I was. I joined the program. It was a coaching program. And I was in the program for about maybe 7 months before we got this deal under contract. And then it takes, about whatever it was, 2 to 3 months to close the deal. So yeah, about a year from when I hired that program to closing the first deal there.
Yeah, 7 months is actually, that's pretty quick. We had Gino Barbaro on the show. I'm not sure if you've heard of him. It's hard not to hear a Gino, but yeah, it took Jake and Gino 18 months of just turning over every stone out there. So how did you find this deal? Like, how did the opportunity come to you? Was it on market? Was it off market? Was it through a relationship? Like, tell me about that.
Yeah, so it was through a broker. And even now we still source most of our deals through brokers. In the multifamily space. And so it was on market, but we were one of, I think, 3 to 4 groups that actually got the deal kind of put in front of us. And that was just through relationships. So, when people are going out and they're prospecting for deals, they might send mailers, they might call owners, they might do all these things, they're prospecting that group of people. We do the same thing. It's really just for brokers, or our group of prospects or brokers. And so we build that connection with them. And when the time came up, this broker said, hey, while I have you on the phone, I got this 40 unit deal. I don't know, I'm going to take it out to market here in the next month or two. Why don't you take a look at it first? Mm-hmm. And we were able to scoot. It really didn't go through a mass marketing phase, but it did go to, a couple of people, but we were the ones able to move fast enough on it to lock it up. Because that was something that was important to the seller, was just time. And we were able to move pretty quickly on it and lock it up before any other group could.
So would you say, because in my definition, this would be like a broker off market deal, like before it hits like LoopNet or Crexy and that sort of thing. So were you like on the A list? Were you on the B list before this came to like to the typical marketing channels?
Yeah. So, this was the first deal that we had ever done, ever, not just in this market, like ever. And so it's hard to say that, we were on this A list because a lot of times the way the funnel goes is, you're going to have your big players in the market. The 6 or 7 groups that own a majority of the properties there, I consider that the A list. You're going to go to them and say, hey guys, do you want to buy this property first? Then you might have the smaller subset, maybe the next 50% of people who own everything there. Really, I think they always say you got to be in the right place at the right time. And really the only way to ensure that that happens to you is by just being there all the time, being there consistently and like you said, showing up and turning over the stones. If I would have called that broker a week later and just to catch up or just to say, hey, by the way, does anything come up? Would we have gotten it? Probably not. At that point, it probably would have gone to one of those other groups and they would have been able to move a little bit faster on it. So, I want to say it's a little bit of luck, but in this business, you make your own luck. And, it's just by being there and showing up all the time, all the time, all the time. And then eventually you're going to get lucky and be in the right place at the right time with the right solution.
Yeah. So what was your strategy and like tactics for like maintaining top of mind with the brokerage community?
Yeah. So I had this, big sales and marketing in my background. So coming from the broker space, I was a salesperson. And I still believe that everybody's in sales no matter what role they're in. And I would just stay in touch with them. I have a CRM system that I put everybody in, and I will follow up. There's not going to be a month that goes by that you don't hear from me if you're one of my brokers on my list. And I'm going to say I'm always going to call you or something, but hey, I'll shoot you a quick text or I'll text them, hey, anything. It'll literally say in my CRM, hey, just ask them something. Like it doesn't matter what it is really. I'll send them an article, say, hey, I saw this new development. What are your thoughts? I'll just call them, hey, want to just pick your brain on anything new coming up that looks interesting to you. Just be there all the time. Let them know you're serious. Most people, when they call brokers, they'll stop after 2 to 3 times. So all you really need to do to stand above most of the crowd is hit like that 4th touch point, that 5th touch point, and now you're kind of in their realm, like in their space. So yeah, just keep at it. Now you don't need to just call them and just say, hey, do you have any deals? At some point you're going to build a little bit of a relationship. What I tell people is no matter what day it is during the week, you're always either just coming from a weekend or approaching a weekend. So really quick, hey man, do anything this weekend? Got anything fun this weekend? Hey, I'm going to be in town in a couple of weeks. What's fun to do out there? Like add a little bit of personal spice to it. But yeah, I would reach out whatever cadence is comfortable for you. For me, it was monthly. And that just kind of kept us top of mind.
Yeah, no, that's pure gold because I mean, I thought that when I first started, climbing the commercial ladder was, hey, I'm going to call this broker once, ask him if he's got any deals coming up. And then, oh yeah, he's going to automatically think of me when something comes up 6 months later, or even a month later. That's the thing is that, it's like you have it's a marketing, marketing tactic in terms of like keeping top of mind. Like the reason why, these huge monster brands like Apple and Nike, have this branding through just, it's constantly in your face. Now you don't need to be as annoying as hell, calling a broker every single week and driving them insane. But yeah, just like that sort of thing. I mean, one of the things I use is, if I find like I have a really, really scary kind of like auditory memory. And so there's little things that I pick up on in terms of conversations, like when I sit down with a broker for lunch about like something, maybe a little bit of hobby that they have, or like, just this little tiny, like, item of information, right? And then I'll listen to a podcast that has nothing to do with real estate or an article, and I'll just shoot it to them and say like, "Hey, I thought of you when I had this." Like so, so it doesn't always need to be like, "Hey, buddy, you got any deals? Hey, buddy, you got any deals?" It can be just that sort of like you want to have like that I call it the best friends conversations with people. So it's what I learned in leasing. You're not trying to go for the throat every single time you have a conversation with somebody, because that doesn't make them feel good. And people like to do business with people that make them feel good doing business with them. So let's take it a step further.
That's a really powerful phrase. Hey, I thought of you. Like that's such a powerful phrase. Somebody one time they had sent me an article. I don't remember what it was about. Something kind of minute, something that really wasn't important to me, but it just said, hey, I thought of you. I remember last time we spoke, you briefly mentioned whatever you like the movie Step Brothers. Oh, here's an article about it. Whatever it was. It really wasn't a big deal to me, but it was just cool. Like, oh man, I appreciate it. The article itself may not be valuable to me at the time, but I'm like, oh man, that's really awesome. So I think that's a really good power phrase. Like, hey, I thought of you. That's a really good one. So you sprinkle that in. I mean, personal relationship, business relationships, everything. So I think that, yeah, I don't want to brush over that because that's a really good phrase that I use pretty frequently.
Absolutely. So let's bring it a step further. Okay, so you got this deal in front on your desk, right? You're in a, kind of like the small group. Maybe they, the A-listers passed over it, right?
Yeah.
So what happened after that point in time?
Yeah. So, I underwrote the deal, and anybody who underwrites multifamily kind of gets this. And if you don't, and you're going to start pursuing it, you'll see this. It's almost weird when something actually makes sense, like when the numbers actually work out, right? Because so many deals, and I was underwriting at the time. We tend to make offers on about 1% of the deals that we underwrite. That seems to hold pretty true year after year. About 1% of the deals we underwrite. And at this point, I think I'd underwritten about 200 properties to really get this one. And the spreadsheets were green and all the boxes that were supposed to be green. And I was like, okay, you almost get suspicious of, well, what's wrong with it? What am I missing? Ran it by my coach at the time. And I said, hey, this looks really good. What other due diligence do I need to do? And he gave me, hey, I'd call the fire department there, the police department there, get the story on the property, go, look on Google Maps, do all this stuff. And, he walked me through a kind of a step above due diligence checklist. So I did all those. Everything seemed to check out. We knew it wasn't in a neighborhood that was a phenomenal A-class neighborhood, but it wasn't, you didn't have to duck and weave while you were there, which we were totally fine with. And we were very well aware that the property needed a ton of work, which again, in the value add space, that's almost a positive thing for you. And so at that time, it was time for us to go to a conference. So this annual conference that this coaching group has. And I'm still talking to the broker in between then. I'm talking to a couple lenders on the property. They're telling me all the debt options. Okay, I'm kind of underwriting those options as well. And my coach had told me, hey, this deal, it's your first deal. It's going to take a ton of work. And you don't live there, you can't manage this property. You can manage remotely, but it's just another obstacle. And he'd actually said, I think this deal is too risky for your first deal, so I would probably pass on it. And I said, yeah, that makes sense. That's a logical point. And during the conference, you're meeting a ton of people, and this one guy stuck out at me because he builds apartments. And he's, I've been a contractor for, 40 years. I did flooring, I did carpeting. I built some of the hotels in Vegas. I built some of the nightclubs in Vegas. And it was really cool. And I just said, hey, I want to get your opinion on this property. Send him over the deck and sent him the underwriting. And he looks and he's like, oh yeah, this is pretty simple. We're going to do this, and still to this day, he does the construction knowledge in the company, right? So everything passes by him. But I said, hey, would you do the deal with me? I don't have that construction knowledge. I need somebody like you on there. We can travel there every month. We can take turns to manage the project. And you just take charge of the construction project. And he goes, yeah, absolutely. The numbers look good. I like the neighborhood. He actually had a business partner as well who grew up in St. Louis and knew that area, and said, okay, yeah, said almost exactly what I said. It's not the best area, but it's not, you'll be fine going there. Okay, perfect. So everything kind of checked out, everything fell into place, and then we moved on it. But without that partnership, without that knowledge base, it probably would have been too risky for me to take on by myself, and it probably would have passed on it. So again, partnerships really, really big in this business.
Absolutely, yeah. And I've had for every deal I've ever done, I've always had 5 people trying to talk me out of it.
Yeah,
so
that's a good exercise. Yeah.
Yeah, I get cautious when everybody's telling me it's a slam dunk, right?
Yeah.
So you're always going to have people that are going to try to talk you out of it. But no, that's awesome that you identified where your potential weaknesses might be on the deal, and you de-risked it by bringing somebody in that had the core competence to kind of bring that piece of the puzzle to the table.
Yeah.
That's awesome. So let's bring it a step further. Did you write an LOI at this point in time? Did you have it under contract when you had this meeting with this contractor?
Yeah, so LOI goes out, and then we go back and forth on some key terms there. But at the end of the day, we really knew exactly what the property needed. We already had our inspections ordered. We had already seen the property in person. So it was more just crossing the T's and dotting the I's, and making sure everybody's warm and fuzzy about everything.
Mhm.
And then the PSA again, pretty quick. We were really, really specific on the LOI. So the PSA went pretty quick again. Again, just minor details of, hey, I want this day. Well, what if this day falls on a weekend? Then what happened? Stuff that's what the lawyers get paid to kind of figure out. And once we put under contract, that's when the process started. It took us about 2 months to like I said, 2 or 3 months to close that deal. Inspections were big for us, so we ordered every single inspection we possibly could. We had to get an exact scope of work, so the bank also needed those as well. And we had a pretty good sense, again, with my partner, who builds properties. It was pretty accurate to what we knew the scope of work would be. So nothing really big came from that. And again, that's because of partnerships. Wouldn't have been able to do that without that. And the scope of work, I totally underestimated, which is pretty common again for rookies in the business. And my partner kind of brought us to reality. And again, the numbers still worked. So put under contract, closed it within a couple of months, and then really got to work on the value add portion of it.
Yeah, absolutely. So let's talk about the capital stack and the numbers here, right? So what was the
Yeah.
purchase price in the property?
Yeah, it was $1 million.
$1 million for 40
Yeah.
units?
Yeah. So about
Oh, this
25.
thing must have been hammered as hell.
It was, yeah, it was beat up. It was beat up. It needed everything. I mean, really needed everything. So it was a neglected property, and it was, essentially completely neglected. Even the current tenants that were in there, they had leases, but the leases they had signed were templates. So the lease had actually said in big brackets, tenant name. Like they didn't put in their actual name. They had just sent them the template and they signed it. So yeah, this thing was beat to hell up. And then, we put in about 600,000 in CapEx into it, and, really over almost tripled its value just by doing that. But yeah, it was pretty beat up, but that for investors spells a lot of upside as well.
Yeah, absolutely. So you got $1 million for the price, 600,000 in CapEx. What else,
Yeah.
what else in the capital stack? Was your total capital stack about 1.6 million then?
About 1.6. Yeah.
Okay. Okay.
Yep.
All right. So how much did you have to secure in bank financing? And then how much did you have to raise?
Yeah. So we got 100% of the CapEx financed, and we're able to get 80% leverage on it, I believe 80, 75, something like that. So it was pretty good. Now, one thing to think about is with these smaller deals, a lot of the times the lending is more limited, right? It's tough to get some banks excited or some lenders excited about a small $1 million deal when they're doing 20 million, 30 million, $50 million deals, and their checks are a lot bigger because of it. So that's one thing to consider. And that was a big eye opener for us as well. And everything they said in the coaching program kind of confirmed that, like, hey, these smaller deals, they might be a little bit tougher. You might not get as good terms with banks because not as many banks are lined up around the block to do something this small. So, I would say the lending we ended up getting good terms, but it was more difficult to finance this thing because of the size than some of our larger properties. Even when the larger properties have needed a lot of work, just the sheer size and the purchase price was a bit of an obstacle there. So whatever that math works out to, we only had to put about 20, let's call it 25% down, and then let's say another, 5% in closing cost. So about 30,000 of about $1 million, or 30% of about $1 million.
Okay. Okay. So around a $300,000 raise.
Yeah.
So let's keep talking about the debt. So this was 80% loan to value based upon its like loan to cost based upon purchase price, or loan to value on appraisal.
Loan to cost based on purchase price.
Okay.
Yeah.
Okay.
So off the $1
All
million
right.
bucks. Yep.
So 300 G's. All right. You got to raise this money. It's like, did you have that sitting in your pocket or in your bank account?
I didn't. So we ended up JVing this among 4 partners. So me and the construction guy were really the key two. And then we had 2 other people that we said, hey, let's go and complete the raise. So we really didn't do a syndication structure, both for the size, syndication, there's some additional costs and some additional legalities to it, which is why most syndications you're going to reserve for a little bigger properties. And then also for the risk, we didn't want to bring on a bunch of investors and say, hey, we're going to syndicate this property, give us your money. And they're going to ask, well, have you done this before? And we have to say, well, no. And that's a tough sell, even though you're in these coaching programs, these mentorships, and my mentor at the time, is guiding us on the deal. we just didn't feel comfortable doing that. So the money came from all four of us. It was not evenly split among the four of us. There was just different, but me and the construction partner put in more of the sweat equity of it. So we put in a little bit less. I'd actually have to remember what those figures are, but we put in a little bit less. We put in maybe 30% compared to their 70%, something like that. But yeah, it wasn't really a syndication, but we had some investors that came in as a JV structure.
Okay, perfect. So how were the membership interests like split on that JV deal? Like, how much did you and your construction partner own, and kind of tell me about that?
Yeah, we did everything equal parts. So everything equal parts. Everybody was a 25% shareholder in this property. Just fulfilled different things. So some people, yes, their buy-in was a little bit more, but they were more of the passive partners in it, right? And then some people did more work. Specifically me and this other guy, my other main partner, did more of the work. So yeah, everything was split evenly with us.
Okay, so how did the other things work in terms of like, were you paying a preferred return based upon invested capital? Were you it looked like there was some probably deferral needed here, because in my opinion, like $1 million for a 40-unit property spells to me distress. Tell me about that.
Yeah, so we didn't pay out any prefs, and it was just an even split on everything. So once you sell the property, which we're actually getting ready to do here in this month, is sell the property. And again, we essentially tripled the value of this thing. We've split everything 4 ways. So once we stabilized cash flow distributions, we didn't have a pref. And once this thing sells off, we're all gonna cash out on a fourth of it. So everything was pretty split evenly, pretty simple structure. We're not doing prefs, at least on that one. We didn't do any catch ups. We didn't have hurdles. It was pretty simple, pretty straightforward.
Yeah, absolutely. So to that note, but you had bank financing from day one, where you had debt service that was due. Did you get like an interest only period on this loan, and how were you able to float the debt service and other expenses? Because obviously there's not just the mortgage payment, there's other expenses as well. How'd you float that while you were able to reposition this property and lease it up?
Yeah, so you just have to pay it. Right, you just have to pay it out of pocket. So we projected it would take us we said about 2 years, which was a pretty conservative figure, to get this property up. And so the debt payments were, I think, like $8,000 or something like that a month, or 7,000, something like that. And so we just figured, okay, 7 times 12 times 2, okay, that's what we're going to hold aside as well. And we had that cash sitting there, so we knew that we could draw from that. And yeah, all these bridge payments these bridge loans are going to be interest only. So yeah, our debt service, which really was the main expense, because everything else was capex. Every single thing else we put on the bank's credit card, and just paid for it and got it pushed through. So yeah, we knew that we would have to float the debt service, and that's just something that we pre-planned for.
Okay, so you overraised on the front end, which you thought your cash burn was going to be?
Yeah, we did about 2 years, and we knew realistically it took us closer to 1 year to get things up and running and ready to go. So we had about double than what we needed.
Okay, so you said about sideways, up, down, diagonally. Like, what? Give us some battle scars on this deal. What went wrong?
Man, so the biggest things that went wrong is well, first is different municipalities have different timelines for getting certain things approved, getting certain permits out. And I don't mean to bash on St. Louis County, but I'm going to bash on St. Louis County. That has been
it's your last property there.
Yeah, it has just been by far. That was the worst experience we've had with working with a city to do something. Now, most of the time, cities want this investment. It was a dilapidated building in this neighborhood. It was really the last building that was just trashed. It was garbage. And what happens when you have trash and garbage buildings is nobody lives there. And what happens when you have vacant buildings is you have squatters, you have crime. That's where drug dealers kind of make roots. So most cities want that out, and they would love for somebody to come up, buy this thing, put in the money, stabilize it, and then have a decent property there. God, St. Louis just does not. Now, we were not within the city. So St. Louis has its city, then it has the county of St. Louis. I've heard the city is a little bit more intense. So we felt, okay, being in the county, we might have a little bit easier time. Yeah, we just didn't. Inspection after re-inspection after re-inspection after re-inspection after literally 6 or 7 or 8 times, every unit, different inspectors coming by saying, you got to do this, this, and this. Okay, we'll do it. Get the new inspector in. Oh, that inspector didn't account for, the sun will rise in the east. So now you got to do this, this, and this. And it's like, my God, I mean, nobody knows what they're doing over there. Nobody knows the requirements that we need to hit. So they're telling us all different things. And that, of course, delays things, that incurs additional costs because you got to have your contractors redo things. And okay, now the smoke detectors, they say we need a new one in these. So to me, that was such a pain. And it makes us really not like investing in that area anymore. So we'll probably avoid any bigger projects like that. But that was a huge pain, like thorn in our side. And then another thing is contractors. So you got to stay on top of your contractors quite a bit. Our contractor probably stole at least $100,000 from us in labor costs and in, stolen materials that happened to get stolen when the cameras weren't working that day. And now we can't log into the system. And so, we knew that he was stealing from us, but we weren't able to really get in a position where we could prove it for insurance purposes. And a lot of times we gave that contractor too much power, like almost prepaying for things too early. So we didn't want to accuse him and have him walk off the job. And we've kind of already paid him for these tasks. And so, the big thing was personnel. We didn't have a trusted, vetted team in that area because, again, we just hadn't done business in that area at that time. And the local government's there. I mean, both of those things really worked against us. We went over budget on the project by, about $150,000, $200,000. Which is fine. We're still going to make a really good killing on the deal. But, if you have investors on, those are not things that you really want to do or be set up for. So those are two really, really big things. We gave way too much power to the contractor up front by trusting them too much. And we were not well versed in what are the requirements that the city's going to need to give us an easier time to push this stuff through.
Yeah. Yeah. So, all right, we're going to jump into live Q&A pretty soon and wrap up the episode. But the last question I kind of had was, fast forward to today, right? What is this? I know you're going to sell it soon. So, but what is this deal like? What does this deal look like from a financial complexion to you guys and your partners?
Yeah. So, so we bought it at $1 million. We put in about 700. Yeah, let's call it $700,000 after points and fees and whatever. So in this thing about 1.7, stabilized value is about 3.4. And so, we're making a pretty good return on that one. And we're set to, we have a couple of, I think some offers will be coming in probably this week on it. And so we're going to entertain those, and really we're in a good spot. The cash return right now is like in the high double digits, just because we had such a low basis on it. So depending on what prices and terms we get, we could even just keep it. So that's another big thing, is having multiple exit strategies. We have our debt terms lined up. We have people who would love to refinance, put different debt on this thing. So we have some multiple exits there. So it's going to depend on how the offers shake out, but we're exploring a couple options now.
Yeah. So before distributions, like, what do you think this thing, like, what does this thing cash flow per year, like just straight up free cash flow?
Geez, I'd have to go back and look. I mean, our cash, we ran the numbers again, we were doing about 16% cash return on cash that we put in, which is phenomenal. I mean, those are the returns people go for right now. So yeah, it's a healthy cash flowing property as well. We have some other projects that we're eyeing that we're excited about, what we might want to sell it and trade out of it. But yeah, it's definitely would not hurt to hold either.
Yeah, absolutely. All right, Justin, we're going to jump into the live Q&A with our people on Facebook and Instagram, and then actually on our Zoom, our live Zoom call here. So
yeah, we have an audience.
Yeah, absolutely. It's like the Oprah show for real estate investors, people. So, hey, if you want to get on the live Q&A, make sure to join the Go Big Live Real Estate Investors podcast, or Real Estate Investors Facebook group. And you can get on live Q&A, ask questions directly to guys like Justin, like Gino Barbaro, and these titans in real estate that we so admire. So for now, we're signing off. Thank you so much for being on, Justin. I appreciate it.
Yeah, thanks so much. This was fantastic.